All right, let's dive into Fannie Mae's latest earnings report. We're going to look past the huge headline-grabbing numbers and really figure out what they mean for the U.S. housing market and for the massive company that's pretty much at the center of it all.
So here's our game plan. First, we'll hit that big profit number. Then, we're going to peel back the onion a bit and see what's actually driving it. We'll look at the two sides of their business, single-family and multifamily, because they're telling very different stories right now. Then we'll get into their big strategy for building up a financial fortress. And finally, the most important part, we'll connect all of this back to you, to the real world. Sound good? Let's do it.
Okay, first things first. Let's talk about the number that everyone always looks at first, the bottom line for Q3. So, Fannie Mae pulled in a net income of $3.9 billion just for the quarter. That is a massive number, and it really shows you how profitable this business is. But, a big number like that, it never ever tells the whole story. And this is where we get some much-needed context. So, yeah, that $3.9 billion, it's up a pretty healthy 16% from the last quarter. But, and this is a big but, it's actually down 5% from this time last year. And the reason for that dip? Well, it's mostly because they're stashing away more cash to cover any loans that might go bad down the road. So the story's kind of mixed, right? Strong growth right now, but not quite hitting the highs we saw a year ago. So you might be wondering, how does Fannie Mae keep making so much money quarter after quarter? I mean, it's incredibly consistent. Well, it all comes down to their core business, which is basically this giant engine for the entire housing market. The secret sauce? It's something called guarantee fees. The easiest way to think about it is like insurance. For a small fee, Fannie Mae tells a lender, hey, we'll cover you if that mortgage goes bad. They guarantee it. This takes a ton of risk off the table for lenders, and that's what keeps the money for mortgages flowing through the whole system. And just how big a deal is this? Well, check this out. Guarantee fees made up a whopping 81% of their total revenue this quarter. I mean, this isn't some side hustle. This is it. It's the absolute bedrock of their whole business model. Super stable, super predictable. It's a money-making machine. But here's where it gets interesting. Fannie Mae's business isn't just one big thing. It's really split into two main parts. You've got single-family homes on one side and multifamily apartments on the other. And right now, man, are they telling two completely different stories. First off, let's just get a sense of the scale here. The single-family side of the business, your typical home mortgage, is more than 6 times bigger than the multifamily side. So look, both are definitely important, but whatever happens in single-family is going to have a way bigger impact on the company's bottom line. It's just simple math. And this is exactly where those two stories split. The single-family business, it's doing pretty great. The credit quality of those loans is really high, and yeah, delinquencies are up a little bit, but the foundation is rock solid. But then you look at multifamily, and it's feeling the pressure. We're seeing more and more delinquent loans and even charge-offs. That's when they basically have to say, okay, we're not getting all of this money back. And it's all because rents aren't growing as fast and properties just aren't bringing in as much income. Yeah, and this quote from their own report really nails it. They talk about accumulated pressure on properties following sustained market challenges. That's corporate speak for things have been tough for a while and it's starting to show. This is really the one part of the business that's flashing some warning signs. Okay, so with that pressure point in mind, what's Fannie Mae doing to prepare for whatever comes next? Well, their number one priority is crystal clear. They are building a financial fortress, a giant cushion of cash to handle any kind of economic storm that might come their way. And honestly, the progress they've made is pretty remarkable. Their net worth is now over $105 billion. Get this, $92 billion of that has been added just since the beginning of 2020. The strategy is super simple but incredibly powerful. Don't pay out profits to shareholders. Instead, keep every single dollar and use it to build up that fortress. But here's a wild little paradox for you. Even with a net worth of over $100 billion, according to the really strict government rules, they still have a capital deficit of more than $25 billion. It's kind of crazy, right? These rules came out of the 2008 crisis, and they're designed to be extra tough, setting a super high bar for safety to make sure the system can't crash again. So, what's the plan to close that gap? It's pretty straightforward, really. Step 1, keep all the profits. Step 2, manage your risk like a hawk, especially in that multifamily space we talked about. And step 3, just keep marching forward, quarter after quarter, until that deficit is gone and they're a fully capitalized company. All right, we've been throwing around some huge numbers, billions of dollars, regulatory capital. But what does all this actually mean for you, for the housing market, for someone just trying to buy a house or rent an apartment? Let's connect those dots. This is the real-world impact. In just the last 3 months, Fannie Mae pumped $109 billion of liquidity, of cash, into the mortgage market. That's the money that lets banks and lenders give out mortgages to people buying homes. I'm not exaggerating when I say that without that flow of cash, the housing market would grind to a halt. And that money, it turns directly into roofs over people's heads. In this quarter alone, Fannie Mae helped more than 400,000 American households buy, refinance, or rent a home. This is where all those financial numbers actually meet the real world. And let's dig into that number a little more. Of those 400,000 households, more than 200,000 were people buying a home. And here's the really cool part. About half of them, over 100,000, were first-time homebuyers. That's huge. On top of that, they also helped over 23,000 families stay in their homes by offering assistance. So here's the main takeaway, the crucial point. All that stuff that sounds kind of boring, the net income, the guarantee fees, the capital rules, it's all directly connected to Fannie Mae's ability to do its job. A financially strong Fannie Mae is what guarantees that there will be money for mortgages, whether the economy is booming or struggling. And all of this leaves us with the one big central question. Look, the company is laser-focused on building that financial fortress, and they absolutely should be. But the real challenge, the tightrope they have to walk, is this. Can they keep balancing that need for rock-solid stability with the mission to keep housing affordable and accessible for regular Americans? That, right there, is the key question we'll be watching in the months and years to come.